Welcome to the Angels Brief, the podcast series. We bring together the smartest minds in angel investing and ambitious startup founders to share their stories, insights, experience, and much more. The host for today's episode is Duran York, the CEO of Cityside Ventures and the co-founder of Birmingham Angels. So let's get to it.
Good morning, everybody. Welcome to our weekly podcast, the Angels Brief, which intend to actually open conversation about angel investing in the state of Michigan. As everybody knows, this ecosystem in Michigan is exploding right now. There's many startup companies looking for early stage capital, and we are the angel investors, want to bring the founders and other stakeholders in the community to talk about angel investing, to bring it to the foreground and the forefront of a lot of people that have the capital to invest. And let's dive into it. Today, I have a special guest here. I have Brenda Jones. She is the founder and the CEO of one of our portfolio company, Ulendo. I'll let you introduce yourself.
Yeah, Brenda Jones here, CEO of Ulendo. We are a University of Michigan spin-out that makes software for advanced manufacturing machines like 3D printers and industrial robots. This is actually my second gig as an early stage CEO. The first one, I did not do fundraising. We bootstrapped the company and then was acquired, and then we were acquired. So Ulendo is my first time having a leadership role where I had to do fundraising. So it'll be I'll come at it from that perspective as a very early. I'm not an experienced fundraiser.
No, I appreciate it. So as you know, my ex-partner, or my retired partner, David Weaver, which some of you know, actually created the first angel group in the state of Michigan in 1999. Since then till today, there's about 18 to 20 angel group across the state that supposedly deploy early stage capital. But still, we're experiencing a lot of pains, both from the investor perspective and the founder's perspective in raising early stage capital, right? Mm-hmm. So Brenda, just give us kind of, in your own words, the experience of raising capital for Ulendo so far.
Sure. Well, we started at the end of 2022, the beginning of 2023, which was an awkward time to be raising capital. Inflation was raging, and we had the whole Silicon Valley Bank situation happen. So it was challenging. It was like I mentioned before, it was my first time raising money, so it was even more of an uphill battle for myself. But as an early stage company, of course, we did what normally folks do, is they focus on angel investment upfront, friends and family, and sometimes groups that are patient capital. For example, one of Ulendo's first investors is Innovation Partnerships at the University of Michigan. So since we're a University of Michigan spin-out, they are highly incented to help us out as much as possible and actually give us some guidance on, someone like myself, someone who hasn't raised funds before, kind of guiding myself and the company along our first fundraising activities.
Now, Brenda, from your experience so far, raising money for Ulendo, and I'm sure you interact with most of the angel groups in the state of Michigan. Mm-hmm. What would you say some of the challenges and some of the positive in your experience?
Well, you're probably not going to be surprised at my first comment on this. Usually when folks think of angel investors, they think of investors who are willing to take on a lot more risk than the next step, which is venture capital. Sometimes it seems like there are differences in angel groups' risk tolerance, and some will say you're too early, which seems a bit of a conflict. But that's one thing that we did run into. We, of course, are an early stage company. We were pre-revenue, but we did have some responses back from some of the angel groups that were still too early. So that's one challenge. The other challenge is there are some angel groups that work as an investment team versus having individual investors make their own investment. of course, as you would imagine, from a founder and CEO standpoint, it's much more cost efficient or time efficient to have an angel group, have a central leadership, make a decision on a company, and then do something like a capital call. But we completely understand that there are different types of angel groups, and the angel groups that are comprised of individuals are sometimes more difficult to wrangle. I've had a couple of people talk about it's like herding cats, and that's not my term. That's the term from someone who runs one of those angel groups. So the time to I guess the third thing is travel around the state of Michigan during our first fundraising route was a bit taxing. As you mentioned, Duran, that there's lots of angel groups in the state of Michigan, and having to do a presentation at each individual one is time consuming. But we're raising money, and that's the way they're organized. So that's what we did.
Okay, and there's a misconception in many ways. When you say angel investing, it's always referred to, at least from my book, to early stage companies, i.e., they are not in the market yet. They're pre-revenue. They just passed the proof of concept. They don't have much history to prove. That's, in my book, true angel investing. And I hear from founders like yourself that there's different angel groups have different criteria of investment, and I don't know, some percentages, maybe half of them are not true angels from the sense that they require a lot more than a traditional angel's going to require. Is this
right? That's exactly my experience. And in fact, sometimes it comes down to what investment vehicle they're willing to deal with. I ran into one angel group that only does priced rounds, which it can be very expensive from a time standpoint and from a legal expense standpoint. So that's an example where those early stage instruments like safes and convertible notes are not even possible with some of the angel groups. But that's their thesis, and that's what they want to do.
Okay, so if you kind of talk to other funders out there that raising capital, and they're going to ask you, okay, Brenda, give us some tips what to raise capital. What would you say to them?
Yeah. So I would try to focus on the angel groups that have that central management approach, where there are one or two people who kind of select or put together a due diligence team from amongst all of the angels to make a decision and then do a capital call. Those situations are much more structured. They're easy to follow up on, and I think, maybe you get a better result. I guess I'm not sure about that. But as far as a time standpoint, trying to focus on those types of angel groups early on is good.
And there's definitely a big gap between the early stage or the angel investing community in Michigan compared to other ecosystem as Chicago, New York, Silicon Valley, and so forth. I know you're smiling, so
yes.
Tell me your experience interacting with other angels outside of state of Michigan.
Yes. So just as far as like the instrument goes, let's just take that. Much more angels outside of, more conservative Midwest are much more open to doing things like a safe. So there's just one example right there. Much more open to having zero revenue and maybe not even very many, product market fit examples quite yet. I think it's a risk tolerance has a lot to do with it. Now, on the other side, there's an appreciation for the company being capital efficient. I have noticed that our efforts as a company to be extremely careful about our spend and weather the storm, because there will be storms, is very much appreciated from angels in our geographic area.
Okay, so I got it. One of the things that we experience as Birmingham Angels, and you've been in our event once or twice, that when we talk to those angels or potential angels, say wealthy individuals that looking to become angels investors, that when we're talking about angel investing in the state of Michigan, they'll look at you oh, I didn't know. There's almost, it's almost a non-existence, any kind of communication, both from the state to the county level to anything else about angel investing. Talking about a lot of conversation we hear about venture capitals and private equity, but not so much angel investing, right? Kind of thing from that perspective. So it's interesting to me that when I met an individual last week that considering becoming an angel investor, investing, and he asked me in any given month how many startups in Michigan, and I remember I pulled up the University of Michigan in Centropolis, and all of this is
Yep.
like it's like about 150 to 200 companies, and he said so many I didn't know. So it's like there's a certain amount of lack of, it doesn't get there,
Yes.
so to speak, right?
Yes, I think within our small community, and it is a small community, we're aware of it. But once you break outside that group, there's not a good understanding of the opportunities for high net worth individuals to do angel investing. I think it just doesn't dawn on them.
And I always saying, I mean, it's true. Professor Brophy said it many times. University of Michigan, a startup company here that facing challenges raising early stage capital eventually will leave the state to look for money. And the moment you leave the state, some of them is not going to come back.
That's right.
Right.
That's right.
And I don't know, half of the company that got started at University of Michigan actually end up outside of state of Michigan.
So here's an example where that might come into play. Someone's done a convertible note round and they have a valuation cap on that note, and now they're ready to do a Series A. Priced round where they want the highest valuation possible. What are you going to do? Are you going to limit yourself to VCs? Now this is a VC round.
Right.
VCs in the Midwest, or are you going to go to the coasts to potentially have more folks that will take on risk more and will have higher valuations? So that's one of the things that certainly in my mind, that's what I'm considering. Not that I'm going to go outside the state, move the company outside the state, but certainly I would be looking for investment opportunities where the risk appetite is a little higher.
Okay, so let me run something by you to test your thinking on it. So one of the questions that we asking ourselves in the last 2 years is evaluation really matters in an early stage, and if it is, what's the way to go about it? Because some of the startup companies that coming and raising capital and put evaluation in a company that has nothing to do with reality.
Right.
They pull it out of the hat, or the advisor told them to do that, or they compare it to the last 10 exits in the space in that time. But it really has nothing to do with the company directly. And we as an investor, it's a challenge for us. Should we take the evaluation, the risk on it, or not? So I came with this crazy concept that I'm kind of putting it out there to the community to get some response, right? I call it flex value. What does it mean? If you coming and saying, I'm raising $1 million for my company on a $10 million valuation. And I said, Brenda, okay, what is the performance number you based it on? Is this revenue, profit, number of customer, market share, whatever performance number, right? Let's use revenue because it's easy to understand. And you said, yeah, I want $10 million in valuation because I'm going to do $2 million in revenue in 2 years. And I'm saying it's okay. I'll sign the convertible note, give it $10 million valuation and $2 million revenue. But here's the thing. 24 months from now, we come to convert, and you did only $1 million in revenue. I'll convert in $5 million valuation. But if you did $3 million in revenue, I'm going to convert in $12 million valuation.
Right.
So I'm taking the risk that I may have to pay more down the road, but I'm de-risking myself because you're performing, right?
Right.
Because if you did $1 million in revenue, and you're in a position that you will have to raise more capital.
Yep.
You're going to come back to raise capital, but you're not going to raise it in a different valuation, right?
That's right. Yep.
So which means I'm diluting myself.
Yep.
Instead of saying, listen, I'm betting on you, the driver, right? So if you perform, you got it. If you didn't perform, I gained.
Yes.
What do you think?
So you mentioned this concept to me a couple of weeks ago, and I think it's very attractive from the company standpoint as well. The thing you hate is if there are ambiguous goals that are just really fluffy. By the time you get to, doing in the next round, it would be much more precise and crisp to have specific goals that lead to the valuation. Just real numbers that hold and are written down and are in agreement. As a very execution-oriented CEO, I value that because I want to know what I'm shooting for. And then we'll put all the wood behind that arrow in the company to make sure we get to that objective.
Right, because if you go to the early stage VC to get the Series A with an underperforming company, you're going to get the door smack in your face, and you will have to come back to us. The angel says, well, I'm raising a bridge round, or I'm raising an extended seed, which is all that we hear is like, we get squished.
Yep.
And we are the one that give life to the company by early stage capital. So
That's right.
we believe that we deserve a little bit of better terms.
Yep. That's right.
When we sign a deal, right?
Absolutely.
But it's based on the founder. Look, if you're performing, you got your way. You got your way. If you didn't perform, we don't lose our position, because if we have to raise more capital and put more capital in the company, we're still maintaining the position that originally come to the company. So when you go to Series A, we are not half the position that we originally committed to.
Yeah, absolutely. So how have other angel groups, if I could ask you a question, how have other investors landed on this idea? How is it going?
I just start promoting it this year.
Oh, okay.
I'm talking to, we have later today, I have Skip Simpson on a podcast
okay.
talking about the same topic. So we taking out to the market, say, okay, I tested it with 3 founders that, recently were about to make an investment. I said, listen, we're willing to do it with only with the condition that the valuations can be tied to the flex value
Right.
formula.
Yep.
So we'll define the numbers, we'll define the performance number, we'll put it together, and then 2 years from now, we'll know who gained, right?
Absolutely.
Right?
Well, so our company, the reason why you brought this up is that our company is doing a convertible note bridge round to a Series A at the end of 2025. And in this, we gave comfort to the convertible note investors that are participating in this current round by talking to potential Series A investors to find out what they would be expecting us to do and have on the books if they were to lead or just participate in a round. We didn't ask for any commitment at all. And by talking to several potential Series A investors, we have a nice list of goals now that we know. Then that's what we're going to shoot for. Is we know we have to do the right thing for our current bridge investors to make sure we make it to the Series A, and that the Series A is a good quality fundraising round.
Well, but I'll give you a compliment, because most founders will not think that far out. Most founders will not approach the VC and say, hey, I'm about to approach you for the Series A. Tell me what you need from me so I can go back, do my homework, get the company in the right track. Most of them just, get to that point, they go to Series and they get the door smacked in their face one after another, and then they come back all beaten up to us. The investors say, like, well, we're going to arrange a bridge round. Right now, a bridge round, there's 2 reasons for a bridge round, right? Yes. Underperforming or overperforming, right? If you're overperforming, you want to push the Series A down the road to get the valuation up, which is a great reason to do a bridge round, right? But 65% of the companies that raising the bridge round is because they're underperforming.
Yes.
Right. So it's kind of need to be, or for example, companies that coming with the trick to say, my board approved me to oversubscribe by $300,000. But what it means for me as an investor, that suddenly it's not $8 million valuation. Suddenly it's like $9.5 million valuation, because if you raise more money and the same valuation, my position is getting smaller.
That's right. Yep.
Right. So I'm surprised sometimes how investors willing to accept that instead of saying, wait a minute, something is not. Now, so the question, all in all, how tough do we need to be with the founders in this time in history, or we just need to kind of roll with a punch, so to speak? So
I'd encourage you to be tougher. I mean, this is not an easy job. If you step into a role where you're running an early stage company, you have to have nerves of steel thick skin, and you depend on, when you get investment, you don't, we hope we don't just get money. We hope we get expertise, guidance, etc. I would welcome more input from all of our investors at any time. And if I could go back to your comment about, most entrepreneurs don't think that far ahead, what a Series A investor will be looking for. I want to put in a plug here for innovation partnerships at the University of Michigan. I mentioned at the beginning that certain kinds of money is friendly money, patient money. One of the things that the University of Michigan's, that used to be called the Tech Transfer Office, and now it's Innovation Partnerships, they provide guidance to companies even beyond. They kind of have to take their investor hat off sometimes, and guide leaders of early stage companies through some of these things. And that was one of the recommendations that came from our contact there, is to take it one step further for this round to make sure everyone's comfortable. Figure out what's going to happen in Series A, chart a path for that. Make sure everyone's comfortable that when it's going to, when it could happen, and what would be the key metrics that you have to hit in order to have a good round in the future.
Yeah, it's a great point, because again, we as an investor, just so it's clear to the people that are listening to it, as early stage investor, we want to deploy the capital. We're not sitting here and putting it behind our back and saying nobody should touch it. We want to deploy it, and we want to deploy it fast. The issue always become, because again, we are in Detroit, so the model is simple. We're looking at the driver, we look at the car, look at the race, right? At the end of the day, we're betting on a driver. Mm-hmm. It's like, can we believe that this founder can drive? And then put the gas in the tank and say, drive. So we want to deploy the capital. Mostly when we don't deploy the capital is not our concern or our conservatism. It's because the founder doesn't give us a reason to write the check. Mm-hmm. I will say it in a kind of weird way, and some of the founders should listen to it. Some founders actually talk themselves out of money.
Oh my!
Yeah, seriously, and angel investors is also, there's a nickname for angel investors called affinity investors, and why? Because angel investors like to invest in stuff they like. So if I like coffee, I'm investing in coffee shop. If I like cars, I invest in. So it's like it's a personality of kind of wealthy individuals kind of following their hobbies and the trends and all this. Like, I like golf, I invest in golf and things of that nature. But as affinity investors, and remember, angels investors don't need those investments to make money. They already did. If they do it because they have some passion or some commitment to the local ecosystem. But most of them don't need to do it. So which means that if you get them to work too hard to connect with you, you lose them. Mm-hmm. Mm-hmm. So yes. I hear it after every showcase we're doing here every month in the office, that some investor going to come to me and said, "Oh, I can't listen to Brenda anymore. She's just getting me tired. So forget about it." So founders need to understand that they can talk themselves out of money as much as talk themselves into money. Mm-hmm. Right?
Can I ask you a question? What are the key things that founders say or do to talk themselves out of money?
The first thing, so I was thinking about it. The first thing that we do is that you are trying to give the investor all the information all at once in a 2 minutes thing. You pack everything, and it is overload. That's one. Two, don't provide information. Don't give too much information. Wait till the investor to ask the questions. Don't try to be a smart ass to answer all the questions. I'm going to give you all the information so you're not going to have any more questions. Nah. Don't do that. When you're being asked a question, answer the question. Don't add anything to it. If I ask you, is the background is black? And you can say the correct answer, yes, it's black. Instead of saying it's black, but it looks like a little bit grayish. So I'm not sure.
Kind of hedging, always hedging.
Always hedging. So don't hedge. You answer the question. And when the investors talking to the founders, they want the founders to be with them. I see many founders, when they ask a question, they going all over the place instead of just being with the person that asked the question. I don't know if it's being embarrassed, being afraid, being uncomfortable. I don't know what it is. So that's, and always confirm with the person that is the answer satisfy them. Instead of
Right.
you answer, yeah, it's black, but let me tell you about the green. No, stop. Hold on, right? So that's one of the cues. When you do a presentation, like a PowerPoint presentation, make it clean, not too packed, not too congested, not too. There's some presentation that looks like you try to cramp everything in those 5 slides. Don't do that. Always leave a taste of more, kind of like that the investor wants to taste a little bit more instead of trying to give me all of it, and eventually it's like, okay, it's overload.
Well, it's interesting that you say that because I used to be a coach for the New Enterprise Forum for companies that were doing their first investor pitch.
Right.
And the first thing we always told the entrepreneur is that really the objective of that first pitch is to get the next meeting. You don't have to spend a whole bunch of time explaining the details of the product, which almost all entrepreneurs want to do. It's give enough taste for the potential investor to want to hear more and do a longer meeting where they can dig into some of the details.
It's perfect because it's exactly what you're saying. It's the last thing I wanted to say is there's a certain cue words that you don't want to use when you talk to an investor, because the moment you use them, the investor go like, whoop,
oh, what are those?
shut down. One is like, we are the only one. Or we don't know any other competitors. Listen,
no competitors, right?
There's 100 competitors out there, you just don't know about them. So don't say that. And the one thing that for me and from some of my investors, that's always kind of, it's like it's a turnoff, is like when people do the slide of the size of the market. Listen, we know there's 9 billion people on the planet. We don't need the size of the market. I want to know what your size of the market. I don't need to know the big size of the market.
Right.
Tell me what's the first customer you're going to get tomorrow, not that. So stop talking about the product and talk about the market. I'm interested in how you're going to go to market and make money out of it. Assuming that your product is the right product in the right market, we'll check it later, but not in a presentation.
Yeah.
No.
Right.
It's like too much tack for people and too much thing, and they can't take it.
So I have to tell you, I'm always impressed at what angels can absorb. I was just at a meeting of an angel group where I think it was 8 different companies presented. Now, a couple of them were the long investment, pitches, 15 minutes or so,
Right.
but others were like 5 minutes. And I'm sitting there and I'm listening to all of these presentations for the first time. And I'm sitting there thinking, what is it like to be an angel investor in this room, trying to figure out what is this company's technology? Like, what is the purpose? Sometimes you don't even get it. There's too many platitudes and, common words. It just goes, woof.
I know. And I know which event you're referring to specifically. But here's the thing. Something that I want to give as a gift for everybody that listen to this podcast, if they listen to it. Angels investors are business operators. Most angels are operators. They came from an operation background. They ran a family business. They ran, they own other businesses. They're operators. They're not financial people. They're operators. They listen from how the moving parts going to work together to make the business go. They're not looking at the financials and try to come up with a financial amount, how much money they're going to make. They're operators. I mean, I had a meeting this week with 3 new members in Birmingham Angels that joining us. All came from family business, operating business for 30 years. They understand team dynamic. They understand performance. They understand operation. So the only thing they want to listen to, how you're going to operate the business to get it to the finish line to make money. I don't care how unique your technology is. We say in our world, if I take a lousy driver and I give him the best race car, I'm going to get below average performance. If I take the best driver and give him an average car, I get above average performance. So that's the dynamic that we're listening through from, from and inside of as an investor. Can you drive? And can you take this average car and give me top performance on it? We can fix the car. We can find a race. We can fix the driver.
Yeah.
Right. So it's kind of thing. But so before we closing, if you can list like 3 things that you think people should take away from this, what it would be?
Well, for all of the early stage leaders in the audience, start early. I am always, even though I tell myself, this is going to take a long time, there's always something that comes up. Don't get yourself in a position where you're having to rush through, paperwork and such just to make payroll or anything like that. That's a dire situation, but definitely start early. Number 2, it goes along with it. Think about the next 2 steps. So as we were talking earlier, that if you're doing a round now, how is that going to get you to the next round? What are the milestones that you're going to be focusing on in that time? And the third one is to, I guess this is kind of a platitude, but put yourself in the other person's shoes. It's taken me a while to just, after talking with different angels about how they feel about things and what their interests are, to really get it. And one of the things I've started doing is at the end of any presentation, having some kind of ask for information from the audience. And I recently did it for your group. And lo and behold, I had a specific ask, and less than a week later, someone from your group was having a video call with me to walk me through his knowledge of a certain area of the industry that I was kind of light in. So perfect. It worked out perfectly.
Yeah, I appreciate it.
Mhm.
And yes, the one thing that I want to add to what Brenda is saying, angel investor in general wants to be involved. They want to help. They come from massive years of experience in business and operation in this particular industry, and they want to give it away. So ask away. They will help. I get a call from my investors many times saying, where can I play? Who can I participate with? Who can I help with? And, the founders sometimes kind of keep it kind of like, I'll send you the update a couple times a year, but I don't need your help. Ask for it, because some of it is precious. Brenda, thank you for coming. I appreciate it.
No problem.
We see big things for Ulendo in the future, and hopefully we also going to get involved in this round coming up. And good luck. Stay warm.
Difficult today.
Okay,
Take
thanks.
care.
Are you interested in becoming a member and joining our group? Please contact Jerron York by phone 248-981-6688 or visit our members' website by using the following QR code. We are looking forward to talking to you soon.